Howdy, everybody. Welcome to the Liberty Call for January 16th, 2025. Hope you're having a fantastical day out there in the interwebs. It's beautiful and clear here in Colorado, but it is cold outside. I think the high is maybe hit 40. I don't know. But anyways, before we jump into the news, big banks are raking in cash. JP Morgan and Goldman Sachs posted massive profit jumps in the fourth quarter, fueled by optimism around the incoming administration. Meanwhile, succession plans at JP Morgan and BlackRock are hitting bumps, and Elon Musk is in hot water again. This time facing an SEC lawsuit over his Twitter stock disclosures. On the fintech front, SoFi and Affirm are gaining attention as top picks for younger consumers, and concerns over risks in the booming private credit market are growing. Let's dig in and break it down. But before we do, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell so we can, or so you know when I go live. All right, let's get to the markets. Dow Jones up 1.66%, 707 points, closed at 43,225. S&P 500 up 1.83%, 106 points, closed at 59.49. NASDAQ up 2.45%, the big winner of the day. 466 points, closed at 19,511. The VIX fell 14.22% today. It's at 1605. Canada was up 0.82, Brazil up 2.82, and Mexico up 0.77. In, Europe, Germany was up 1.7%, the UK up 1.21, France up 0.69, the Netherlands up 1.01, Spain up 1.25, Italy up 1.49, Switzerland up 0.69, and Portugal up 1.29. The Russian exchanges were split today. The MOEX down 0.54, RTSI up 0.07, and the overnight markets, the Nikkei in Japan was up 0.09, Australia down 0.22, New Zealand up 0.96. In China, the Shanghai was down 0.43, Shenzhen Component down 1.03, China A50 down 0.38, DJ Shanghai down 0.44, Hang Seng up 0.34, and the Taiwan weighted down 1.24. All right, so those are the markets for today. Let's jump into the market recap. U.S. stocks as key measure of inflation eases, bank kickoff earnings season. Let's go see what's going on today. U.S. stocks surged on Wednesday as inflation data revealed a surprising slowdown in December, easing fears of prolonged inflationary pressures and bolstering hopes for a more stable Federal Reserve policy in 2025. Inflation is cooling more than expected. The headline Consumer Price Index rose by 0.4% month on month in December, slightly faster than November's 0.3%. Year over year, CPI climbed 2.9%, up from 2.7%. However, it was core CPI, excluding volatile components like food and fuel, that captured market attention. Core CPI rose by only 0.2% monthly and 3.2% annually. So that means everything went up 3.2% in that core area, both below market expectations of 0.3 and 3.3. I mean, come on. I mean, basically, it's a tenth off in it's a tenth below expectation. So in their mind, inflation is massively cooled, and we should probably lower rates down to zero. That would be smart. God, these people, I mean, they just want easy credit and to inflate the economy, create problems for people who did not plan for this. And, now we're, just the financial planner in me gets really upset about this stuff. All right. The unexpected cooling in core inflation has reduced fears that the Federal Reserve will maintain a prolonged pause on rate cuts. However, Wall Street remains cautious, with some analysts predicting just one more rate cut in 2025. Macquarie, in a note, reiterated its baseline forecast for a 25 basis point cut by March or May, but acknowledged risks of a later adjustment. Concerns over inflation had heightened following a strong jobs report and President-elect Donald Trump's tariff plans, which could increase price pressures. Markets are now preparing for a slower pace of rate cuts in 2025, with the Fed projecting just 2 this year. Major banks delivering strong earnings. The financial sector helped boost market sentiment as several major banks reported impressive quarterly reports. JP Morgan Chase posted record annual profits, lifting its stock by 2%. Goldman Sachs saw its stock rise by 5% after doubling its Q4 profits. The Wells Fargo gained over 6% on stronger than expected results, while BlackRock rose 5% on record Q4 assets. In corporate moves, Beacon Roofing Supply jumped 9% after receiving an $11 billion takeover offer from QXO, further fueling market optimism. Overall, easing inflation and strong corporate earnings helped lift the investor confidence and boost U.S. stocks midweek. All right, so everybody's in a chipper mood. Let's dive a little deeper into that CPI stuff. The December CPI report from First Trust, Mr. Nate Gersey put this together. So let's see what First Trust has to say. Inflation rose again in December of 24, signaling that the Federal Reserve's fight to control price pressures is far from over. Consumer prices increased by 0.4 for the month, translating to a 4.8% annualized rate, while year over year inflation rose to 2.9%, marking the third consecutive monthly increase. Energy prices drove much of the December spike, with gasoline prices surging 4.4%, though energy prices overall fell 0.5% for the year. They went down mid-year, and now they started going up at the end of the year. If you look at the Brent crude and West Texas Intermediate, they have they're mid-70s right now. I think the last time I looked at it a couple of days ago. Core inflation, which excludes food and energy, rose by 0.2 in December, slightly below the expected 0.3 increase. However, core prices are still climbing at a 2.7% annualized rate, keeping inflation above the Fed's 2% target. Core inflation was up 3.2% for the year, compared to a 3.9% rise back in 23. The main driver of core inflation continues to be housing rents, which increased 0.3% in December. Even when housing rents are excluded from the equation, inflation remains elevated. The super core inflation measure, which strips out food, energy, goods, and rents, rose 0.2% in December and 4.2% over the past year, worse than the 3.9% rise in 23. Despite persistent inflation, the Fed has cut rates by 100 basis points since September. It remains uncertain whether the Fed will maintain a tight monetary policy until inflation consistently falls to 2%. Meanwhile, manufacturing sentiment in New York weakened, with the Empire State Index dropping to negative 12.6 in January from a positive 2.1 in December. All right. So, yeah, the people of First Trust are a little more pessimistic than the financial journalists that were in that first article. All right. From Zero Hedge, consumer prices soared over 21% under Biden and real wages fell. Let's see. This is one of the Tyler Durden articles. All right. Inflation continued its upward trend in December of 24, with consumer price index rising 0.4% month over month, marking the highest monthly increase since March. Annual inflation rose 2.9%. We already covered that, driven largely by surging energy costs. Gasoline jumped 4.4%, contributing a 2.6% rise in the overall energy index. Despite energy prices being down 0.5% for the year, their recent resurgence is reigniting inflation concerns. So again, you got to look at like the last, 3 to 6 months and see where the trend is going, and the trend's going up. First half of last year, it was going down. That's why everyone was, giddy about seeing some deflation in some areas. Core CPI, which excludes volatile food and energy prices, rose by 0.2 month over month, 3.2 year over year. The Fed's preferred measure, super core inflation, which excludes housing and rents, rose by 0.28 in December with an annual rate of 4.17. Key areas of price increases included transportation services up 3.9%, used cars and trucks up 1.2%, and motor vehicle insurance. However, categories like personal care, communication, and alcoholic beverages saw declines. You probably shouldn't drink alcohol. It's bad for you. It really raises my histamine levels, and I feel like crap when I like beer, I like whiskey, scotch, but I just can't drink it anymore. So probably, my body just can't tolerate. Anyways, all right, back to it. Under the Biden administration, consumer prices have increased 21.25% at an average rate of 4.9% annually. In comparison, under Trump, prices rose by 8% or 1.9% annually. Real wages have fallen 1.6% under Biden, while they rose 6.8% under Trump. With energy costs remaining high and monetary supply growth continuing, inflation pressures are expected to persist. The key question now is whether businesses will absorb the rising input costs or pass them on to consumers. I can answer that question for you without having to do a real study. They're going to pass it on to everybody else. Because they just can't. Most businesses run very thin margins. You're not going to get away with, having, I'm not sure what the tariffs that, depending upon where it is, but you raise the cost by 25% to the consumer or with a tariff. And then, I really doubt that businesses are good. They'll absorb a little bit of it just because they'll have to, but yeah, it's a mess. All right. One last article here, Tactically Bearish as Risks Increase. This is written by Lance Roberts via realinvestmentadvice.com. So what is going on that he's bearish? All right. Financial strategist Lance Roberts explains why his firm is adopting a more tactically bearish outlook heading into this year. This approach involves reducing equity exposure and shifting to more value-oriented dividend-paying stocks to manage risks. Those are my favorite, actually. The goal isn't to predict a market crash, but to proactively adjust portfolios in response to rising risks. Oh, but Jake is mad at the UPS guy walking up the driveway with probably my prescription. Anyways, where was I? Risks, including excessive valuation, slow earnings growth, and rising interest rates. Roberts emphasizes that bear markets rarely happen suddenly. They are preceded by warning signs such as widening credit spreads, technical indicators like the S&P 500 moving averages. He notes that while Wall Street analysts remain optimistic about the 2025 earnings, current stock prices are priced for perfection, and that's in quotes, leaving little room for error in the year marked by economic uncertainty. One of the most significant risks to the market is rising interest rates, which have jumped due to fears of inflation, partly driven by new tariff policies under the incoming administration. Higher rates increase borrowing costs, which can eventually impair corporate earnings and slow economic growth. Roberts highlights that rates currently stand near 5%, while economic models suggest they should be closer to 3%, indicating market sentiment may be overreacting. Roberts also warns that excessive valuations could trigger a market correction if earnings growth slows. Historically, rising interest rates have forced investors to reprice assets for lower expected returns, increasing the likelihood of a mean reversion event. The article concludes with a focus on managing risk through active portfolio adjustments. Roberts stresses that acknowledging uncertainty and assessing probabilities are essential to making sound investment decisions. His strategy involves monitoring market dynamics and adjusting portfolios to preserve capital, achieve long-term success. Yep, good stuff. All right. Well, that is everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a jingle. I'd be glad to help you get to wherever your goals are. You probably have already given up on some of those New Year's resolutions. So why not start a new resolution to get financially fit? I mean, getting physically fit is kind of hard in the wintertime because, the weather's bad. And it's, especially where I live, there's snow on the ground everywhere. And getting outside is sometimes tough when there's, ankle deep snow. All right. Well, I hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.